A government shutdown looms in the US after a Trump-backed Republican spending bill is rejected by lawmakers. El Salvador's Bitcoin ambitions may face a setback with an IMF deal on the horizon, and could Europe's love affair with coffee and croissants soon turn sour? Hello, I'm Taiba Aydin and you're watching Money Talks. The Federal Reserve's latest decision to cut interest rates reflects a balancing act between persistent inflation and strong economic growth. While borrowing costs have slightly eased, the central bank has signaled a cautious approach for the coming year. Simultaneously, political uncertainty looms as government funding negotiations falter. The Federal Reserve reduced interest rates to a range of 4.25 to 4.5% and halved its rates outlook to only 2 quarter-point reductions through 2025, reflecting concerns about inflation, which is forecast to rise to 2.5% this year. Despite slower rate cuts, the economy is projected to grow at a pace of 2.1% in 2024, well above potential. Unemployment remains historically low at below 4.3%, reflecting a robust labour market. The Fed raised its neutral rate estimate to 3%, showing it's confident in the economy. Partisan gridlock over the government funding this week has increased the risk of a shutdown, which would only add to the economic uncertainty. A failed House Republican bill leaves the debt ceiling unresolved. For more on this, let's bring in Ross Feingold in Taipei. He's the former Asia chairman at Republicans Abroad. Good to have you with us, Ross. Now, firstly, why didn't Trump's proposed funding go through? We saw dozens of Republicans reject the deal.
The issue is that there's a number of Republicans in the House Republican caucus who are more moderate, and they don't want to take the political risk of a government shutdown. And there's also a number of members of the Republican House caucus who are very conservative. And what they don't like about these spending approaches is it jams in a number of unrelated things to funding the government. It increases the amount of money that the federal government is spending. And it was done on very short notice. It really isn't done with a full procedure of vetting in committees and hearings and things of that nature. So there are a lot of more conservative members of the Republican House caucus who just say, we're tired of doing business this way. Every time we need to fund the government, we get the legislation, the draft bill at the last moment, and it jams in a lot of unrelated things, a lot of spending beyond just the continuing the current level of spending, and we're not going to stand for it. So to their credit, to the extent that that's what their political view is, they voted against it.
And we saw a similar standby last year. How will a potential shutdown of the government impact the US economy and its citizens, particularly given the fact that the holidays are so close by?
It's a great question, and some of it is a bit of a mystery. If we look at the history of government shutdowns, some have gone on for many weeks. Some have only gone on for hours or a few days. There is there's a weekend coming up, and then it's followed by the Christmas Day holiday. So perhaps the damage from a government shutdown over the next 4, 5, or 6 days wouldn't be that detrimental to the economy. It would be, frankly, it would be somewhat limited, and that would buy more time for members of the House and the Senate to work out a new deal that, of course, would require the blessing of President Trump, because Republicans most Republicans in the House and the Senate, they don't want to cross President Trump on this issue. But brief shutdowns, we have a lot of experience with this over the last 40, 50 years. They don't really cause too much damage, but obviously a shutdown that goes on for 3 or 4 weeks would start to cause damage.
Right, and we heard earlier about the Federal Reserve reducing its rates outlook for the upcoming year. How might President-elect Donald Trump's fiscal policies, such as tax cuts and tariff hikes, influence the Fed's monetary strategy?
The really interesting thing there was Fed Reserve Chairman Powell used the word sideways to describe inflation. He said inflation is going sideways, and that's one of the reasons why he said that they voted to have only 2 cuts next year rather than 4 cuts in 2025. So clearly they're concerned about the risk of inflation from tax cuts and higher tariffs, because good economic science says that tax cuts and higher tariffs probably would lead to higher inflation. So clearly, the Fed is still concerned about inflation. They don't think that the inflation problem of the last few years is truly over. And they're concerned about more inflation if there are significant tax cuts and significant customs hikes next year.
All right, Ross Feingold, former Asia chairman at Republicans Abroad. We will have to leave it there. Thank you very much for joining us. Now, Nissan's potential merger with Honda has stirred excitement in the motor industry, with analysts envisioning the creation of a formidable global contender in vehicle manufacturing. This move would enable deeper investments in EV technologies and shared platforms, potentially revitalising struggling players like Nissan. But market reactions reveal differing views on the feasibility and benefits of such a consolidation. Nissan shares jumped more than 23%, hitting their highest gain in years. In contrast, Honda shares slipped 3%, showing the contrasting market sentiments towards the potential mega merger. The combined Nissan-Honda-Mitsubishi enterprise would surpass 8 million vehicle sales annually, trailing only Toyota's 11.2 million and Volkswagen's 9.2 million among global automakers. Nissan has faced challenges recently, with plans to slash 9,000 jobs and cut global production by a fifth. The merger could revitalise its position amid fierce competition in the electric vehicle market. For more on this, we're joined by Steve Fowler, who's an automotive editor and consultant in London. Good to have you with us, Steve. Now, investors seem to have a mixed view on this potential merger. What might be some of the pros and cons if the deal materialises?
Well, I think it'll be very good news for Nissan. As your report quite rightly said, Nissan's been struggling recently. Its sales are down, profitability is down. There have also been rumours of whether the company could survive the whole of 2025. So it's good news for Nissan. Clearly, investors don't think it's quite such good news for Honda, but there is strength in scale. And with the cost, the sheer enormous costs that are involved in developing not only the platforms for electric vehicles, but the batteries, but also the software. You know, everyone talks about the software-defined vehicle. These things are really expensive, hugely expensive, and these companies cannot do it on their own. So getting together reduces the scale of those costs. They're able to spread it across more models. It makes more sense, even down to more prosaic things about merging companies. There are always savings to be made, and they all want to make savings. However, it is complex. It can be hugely difficult for two companies and two different cultures of different companies to work together. There's also the element, of course, that Nissan is part owned by Renault. Nissan is already in a relationship, in an alliance with Renault and Mitsubishi. And of course, that needs to be untangled somehow and work through this potential merger between Honda and Nissan. But the bottom line is there is a safety in scale, safety in numbers, and it will be good news for both brands, I think, to bring more electric vehicles to market.
Right, and how could this potential merger impact the global electric vehicle market, particularly in competing with current EV giants like Tesla and BYD?
I think you've only got to look at the size of those businesses, both BYD and Tesla, and the fact that they have really stolen a march on a lot of other, should we call them legacy automakers, the more established brands, the brands that are trying to switch from making cars with internal combustion engines to these software-defined electric vehicles. You know, undoubtedly, competition is good, and it'll provide good competition for BYD and Tesla, who are running away with things in terms of the electric car market. They are so far ahead of rivals. It's time for the rivals to play catch up. And of course, it's easier for Nissan and Honda to catch up if they're working together.
And you mentioned Renault and Mitsubishi. What role would they play in this?
Yeah, well, Renault, of course, has to agree to this in some way. It owns, I think it's 36% of Nissan at the moment. So Renault may be quite happy to see that relationship part ways. You know, it's very much based on old technology relationships. However, Mitsubishi as well, you know, Mitsubishi are a really small company. So joining forces with Honda and with Nissan culturally a better fit, 3 Japanese companies working together. I see that as very good news for Mitsubishi. I understand shares have jumped in Mitsubishi as well. So good news for them, but I don't see the Renault, Nissan, Mitsubishi alliance lasting very long if Nissan and Honda do decide to merge.
All right, Steve Fowler there in London. Thank you very much for your analysis. Now, El Salvador's Bitcoin dream might be shattered. With an International Monetary Fund deal on the horizon, the nation must decide whether to stick with its gamble or retreat to more conventional paths. Christina Simic reports.
It all began in 2021.
The Bitcoin law is approved.
With those words, El Salvador made history, becoming the first nation to embrace Bitcoin as legal tender. Businesses like George Solis's restaurant dove into the crypto dream.
In business, it's pretty basic. I receive, collect with Bitcoin, and accept Bitcoin. After that, we set aside a portion for savings. And if not, if we don't have enough due to cash flow, there's that backup we have to cover a purchase or something extra.
But the dream has hit a speed bump. On Wednesday, El Salvador signed a $1.4 billion loan agreement with the IMF to stabilise its economy. The IMF wrote in a statement, "The program is also expected to catalyse additional financial support from the World Bank, the Inter-American Development Bank and other regional development banks for a combined overall financial package of over $3.5 billion over the program period." But the deal comes with a catch. It requires the nation to scale back its Bitcoin policies, including that taxes should be paid in dollars. Private companies will also be free to choose if they want to accept Bitcoin. Timing of the decision is surprising, as Bitcoin recently hit a new high of $108,000. El Salvador holds 5,968 Bitcoin, currently valued at approximately $594 million. So is El Salvador's Bitcoin experiment over, or is this just a recalibration of the idea? The world will be watching as the nation navigates its next steps. Christina Simic, TRT World.
Let's get more on this now with Oliver Carding, who's the founder of Crypto Kaiju, joining us from London. Now, Oliver, with this looming IMF deal, can El Salvador maintain its Bitcoin dream while meeting IMF demands?
Yes, I definitely think it can. It's a bit of a recalibration. They're still going to be holding a Bitcoin reserve. The biggest part of the deal is they're going to be shutting down the Shiba wallet. But the Shiba wallet didn't really achieve the mainstream adoption it was hoped for, despite the sort of $1 incentive originally. The decision to wind it down or sell it aligns with the deal, but won't really impact much because they'll still be holding Bitcoin in reserves, and all the indications are that they'll still be purchasing Bitcoin.
And will scaling back Bitcoin policies affect businesses and citizens?
I don't think so. I think it's good that they've opened up the market a little bit. They don't have to use the Shiba market anymore. They don't have to use the Shiba wallet anymore. Businesses and people are now able to choose their own wallets, so that may open more of a market for private wallets to come into the country and operate. It remains to be seen, really, but I don't think looking at the adoption of the Shiba wallet is going to impact much at all for the public or businesses.
Now, with taxes required to be paid in dollars, is El Salvador moving closer to full dollarization? And what does this mean for its financial sovereignty?
Potentially, yeah. In terms of the sovereignty, I don't really know. I think that remains to be seen for the time being. I think it moves a far away from the original policy, but I think we'll have to see how that goes.
Right, and Bitcoin has been incredibly volatile, with it plummeting 9% just today. What impact would this have on El Salvador's adoption of the currency?
I don't think it will. I think, they've bought through the bull market, they've bought through the bear market, they've been committed to it for so long now that I imagine on a cost dollar average, they're doing pretty well. They're well up on their initial investments, but all the indications point to continuing to increase their strategic reserves. So I don't think it's going to have much impact in the short term. I imagine we'll see Bitcoin hit new all-time highs in 2025 once Trump comes into office in America and they begin their plans for some kind of strategic reserve. If anything, I think El Salvador were pretty forward-thinking. I do think that we'll see other governments following their lead in the next few years.
Right, and that brings me to my next question. What can the rest of the world learn from El Salvador's crypto experiment?
At this point, I think we can probably learn that they have to be a bit freer in how they set out the quest and how they implement the strategy itself. Like the Shiba wallet looked a little bit doomed from the start. Businesses had to use that. It's not really within the spirit of crypto or Bitcoin in the first place. But I do think from a strategic reserve point of view, I think there's a lot of benefits. If you look at just the idea of holding Bitcoin over a decade, it's been the top performing investment of all time. So I do think there are benefits there for companies that want to follow suit.
All right, Oliver Carding, we will have to leave it there. Thank you very much for joining us.
Thanks for having me.
Now, inflation in Russia continues to rise as the country deals with poor crop output and the lingering effects of Western sanctions. The central bank has hiked rates this year to control prices, which it says are above expectations. Emre Boz has the details.
As snow blankets the capital Moscow in white, a very expensive winter may be ahead for many. The rate of price rises have been on an upward trend since the beginning of the year. Inflation rose to 8.9% in November, up from 8.5% in the previous month.
Prices have gone up fast and hard in the last 2 years. Before, you could buy a bag of groceries for 1,500 to 2,000 rubles, and it was a normal bag of groceries. Now, of course, it is impossible to buy for such an amount.
And for some consumers, these price rises are making shopping more difficult, with prices for potatoes, a staple food for many Russians, rising by 64% in November.
I limit myself in many things now. I don't buy beef. It's expensive for me. I still buy chicken for soup, milk and bread. I rarely buy cottage cheese either, because everything is very expensive. I buy just enough so that I don't starve to death.
As domestic demand falls in the country, this is bad news for producers who lose out on local consumers. So why are prices rising? One of the main reasons is a severe summer drought followed by extreme frosts, which have affected crop output. And increased costs have also played a role, with wages rising 8.4% year-on-year in September from 7.7% in the previous month. Western sanctions have also made imports more expensive by making logistics and payments for Russian businesses more difficult. The country's trade surplus has continued to fall this year, meaning it's importing more than it's exporting. The surplus fell to more than $9 billion in October, with imports surging 17.4% from 2023. The central bank has responded to price rises by hiking interest rates 200 basis points to 21% in October. This is to reduce any demand-driven inflation by making borrowing more expensive. And the Russian government has also promised to up investments in key sectors to increase supply of goods and services. By increasing supply to meet demand, they hope they can reduce prices. Emre Boz, TRT World.
For centuries, the occupied West Bank city of Nablus has been making the finest olive oil soap. Now, UNESCO has recognized this age-old tradition as part of what it calls the world's intangible cultural heritage. Lara Kulachastan has the story.
In the streets of Nablus, the smell of olive oil fills the air. For generations, families here have been turning olive oil into soap.
Nablus has been famous for centuries for its production of olive oil soap. The Touqan soap factory was established during the Ottoman era in 1872. This factory continues to produce olive oil soap under the brand name Al-Muftahin, a tradition that has persisted since its founding.
In small workshops and factories, the process is simple yet special. Olive oil, water, and lye, a compound of sodium and potassium hydroxide, are mixed together. The mixture is cooked, cooled, and cut by hand into bars of soap.
Soap making is not just a craft, it is a vital part of Palestinian heritage. Therefore, the significance of this decision lies in UNESCO's role in preserving the heritage of the Palestinian people who have inhabited this land since ancient times.
The Toucan soap factory is one of the oldest in Nablus. It once produced 600 tons of soap a year, but today, production is just half that amount. Occupation leading to economic decline has made it harder to keep the tradition alive.
We hope the Palestinian Authority will support this industry by offering various incentives, particularly by exempting it from fees and customs taxes.
Despite the challenges, the recognition by UNESCO gives the soap makers hope. It serves as a reminder of the importance of preserving even the oldest of traditions. Lara Kılıçarslan, TRT World.
Meanwhile, the UK government has outlined plans to create a clean electricity system by 2030 to help make Britain a green energy superpower. Tulay Kalyon Haznederoğlu explains how.
A dramatic rise in European energy prices, seen as a geopolitical weapon since the start of the Ukraine-Russia war. And to stop it, UK's Energy Secretary Ed Miliband has revealed a national plan to switch to sustainable electricity by 2030.
We are at the moment at the mercy of the roller coaster of fossil fuel markets. Gas prices, wherever we get the gas from, subject to the decisions of petrostates and dictators. And your viewers are seeing it in their energy bills, have been seeing it for years, particularly since Russia's invasion of Ukraine. It's time to actually have homegrown, clean energy that we can control.
The government is calling it an ambitious action plan for reaching 95% clean energy by 2030.
And every solar panel we put up, every wind turbine we build, every piece of infrastructure we build gives us more security and gets us on that path to lower bills. And some people aren't going to like it, Naga. Some people aren't going to like more wind turbines, for example, more solar panels. In a way, that's a choice we've got to make as a country. Do we stick to the old, insecure path with all of the dangers that I've outlined, or do we do something different? I say we do something different.
The goal of the plan is also to address the climate crisis, reduce costs, and generate jobs. 95% clean energy for 2030 sounds like a great plan, but critics warn it could push bills even higher. The industry has been calling for new projects for years and welcomed the plans. But the government says ministers will be given final say on approving large wind farms under decarbonisation plan. Tulay Kalyon Haznederoğlu, TRT World, London.
Europe's love affair with coffee and croissants could soon turn sour. A decline in milk production and climate-affected harvests have sent coffee bean and butter prices to record highs, putting increased pressure on bakeries across Europe to pass these higher costs on to consumers. Omar Bakaloğlu reports.
For many Europeans, starting today with a cup of coffee and a croissant is more than just a habit. It's a cherished ritual, but that tradition may become more expensive this winter. Rising costs for butter and coffee beans are threatening to turn a once affordable indulgence into a luxury item.
Butter prices rise so sharply at Christmas, and consumers notice this with a slight delay, because at some point the producers, in this case us, naturally pass on the higher prices that we had to pay when purchasing.
Butter prices have surged by more than 25% across Europe since September, reaching record highs. That's because of a sharp decline in milk production last year in key regions, as lower profits discouraged dairy farmers. Some bakers are now turning to cheaper alternatives like margarine or reducing the size of their croissants to manage rising costs.
You can make the product smaller in size even though the clients always have access to prices and weights. But it's the only way, or else you squeeze it out of your profit margin. But with my taxes, my employees' electricity, water, you have to manage that. On the one hand, you're expected to make your customers happy, but you also have to be a reasonable business owner if you want to survive in the long run.
On the coffee side, global prices are also at historic highs. Brazil, the world's largest coffee producer, has faced droughts and frost, severely reducing yields. Other top exporters like Vietnam and Colombia have also faced similar challenges with extreme weather. For farmers, the rising prices present a bittersweet reality.
We farmers should be happy when the price increases, but due to this throughout, we are not happy because the price increases but the output decreases. So in general, we are happy and we are sad at the same time because the climate changes erratically and we can't grasp those changes.
As prices climb, the coffee and croissant ritual has become a symbol of guns or butter dilemma. Consumers may soon need to decide whether to enjoy their favorite tradition less often or pay a little more for the pleasure. Ömer Bakkaloğlu, TRT World.
And if you have any stories you'd like our reporters to look into or any questions for our experts, you can reach out to us on X at TRT Money Talks. You can also head to our YouTube channel to catch up on all of our stories and interviews. Just do a quick search for TRT World Money Talks. Well, that's all from Money Talks for now. From me and the whole team here in Istanbul, thanks for watching.